Hi, good evening, everybody. Welcome to Private Lending with Marshall Reddick Real Estate. My pleasure to be with you tonight. My name is Patrick Prunty, and I'm going to be your host tonight. Very excited about being on the call. Jam-packed with information. Absolutely going to be an excellent learning experience for you. Be talking about some investment opportunities. Also going to be talking for a special guest tonight, Dmitry Fomachenko from Sense Financial. I'd like to introduce him right out of the gates.
Hey, Patrick, thanks for having me. It's great to be with you and join forces to educate investors on this very important topic.
Awesome. Yeah, no, appreciate you being on the call as well. And yeah, let's continue on. We'll get started here with a poll question, get the audience started. Great, so at this point you should have a poll question there. Dimitri, you want to read it for us?
Sure. So the question is, do you know Marshall Reddick has a private lending program which offers secured mortgage investments? So just select your answer, click on one of the choices.
Yeah, we'll give a couple more seconds here. We're getting a really good response. Take a few other seconds there, crowd, to give us your vote. All right. So we will go ahead and close the poll. So we're going to share the results. 92% of you voted. Thank you so much. And so actually, I'm a little surprised. 55% of you indicating that you did know that we have a private lending program. So I'm super excited to hear that. But 27% saying no. Those of you, we're definitely speaking to you tonight. And for those of you who are curious about what a secured mortgage investment is, that simply means that it's a loan or an investment that is secured against real property. Right? So we'll talk about that a little bit more, but in a nutshell, that's what a secured mortgage investment. It means you have a piece of real estate as security. So I'll go ahead and hide that now, and we'll move right along. Okay, so like I said, most folks here, said that they did realize that Marshall Reddick had the program. And again, that shocked me a little bit. You know, Marshall Reddick's been around since the 70s, and I found that most folks have heard of Marshall Reddick, but not really for our lending, more for our rental property program and for education. We can certainly still help you with that, but tonight's all about private lending. So if you did want to be the landlord, buy and collect rent, certainly always, I mentioned, something we can help you with. But tonight, let's get started. Let's talk about how to lend and collect interest. So compared to rental property, folks, lending offers two major benefits, right? It's truly passive. And what I mean by that is you have no tenants, no maintenance, right? Rental property, it's a great investment. I own several rentals. I know Dimitri is joining us on the call tonight. He does as well. But we both have done several loan type investments over the years. And I don't know about you, Dimitri, but I certainly can say that I prefer the lending now, right? I don't want to have to worry about the water heater going out and some of those things that used to keep me up at night. It also is predictable, right? So with rental property and a lot of other investments, it's very unpredictable, right? Are they going to pay their rent on time? When's the roof going to go out? You know, a lot of different things like that. With the lending side of things, the interest rate doesn't change, at least with us. Our rates are all fixed, right? You collect that monthly check or that interest, and that's that. So again, truly passive and predictable. Two major benefits in my opinion. So private lending, it's nothing new to us here at Marshall Reddick. We've actually been doing it for a number of years, but I wanted to give some facts on the program to really give everybody an understanding about what we're doing. So first and foremost, we offer two programs, and we do that to accommodate the needs of all clients, right? Some people really need liquidity. Other people really need principal protection and safety in their investment. We'll go over those two programs. Our loans move extremely quickly, right? Oftentimes, within a few minutes, we've got lenders interested in funding one of our deals. Loan amounts come in all shapes and sizes. $25,000 is really kind of the lowest amount, but we get all the way up to $1 million and anything in between as well. As of the end of the most recent quarter here, September 30th, our pipeline, meaning the total amount of loans that we have out, exceeds $16 million in capital. All right, that's 201 loans and 97 individual lenders. So it's definitely not a super small program, not a super large program. In total, I said, obviously it's nothing new to Marshall Reddick, but in total we've funded 785 loans, and that totals more than $60 million in capital across those 785 loans. We're also really transparent. I'm going to talk about that a few times throughout the call tonight, but it's important to know that out of those 785 loans we've done to date, we have 33 total defaults, right? Because obviously if you're going to be doing some lending, you need to understand who you're working with and what their track record looks like. So that's roughly, a little over 4%. And don't think extra negative when you hear default, right? Most of the defaults, the lender actually came out on top, right? We've actually not had any foreclosures either. Normally with a default, we get like a deed in lieu where the borrower would just give the lender the property or something like that. But a default doesn't necessarily mean a loss, let alone a loss to your principal investment. So those are just a few facts about what our program looks like today. Let's dive into the two programs that we offer. This is going to be really important for those on the call to understand exactly what our program looks like. Before we do that, let's dive into another poll here. I love audience participation, so I appreciate you guys gracing me with your presence. All right, so you should now have the poll in front of you, and the question is, why would a buyer opt to use private financing with much higher interest rates as opposed to, say, a traditional bank loan? So simple question there. Really appreciate you guys' feedback. So I'm going to segue into our next several slides. So we're going to give it a couple more seconds here. Go ahead and get your vote in. All right, and we'll close the poll. So let's share the results. Very interesting. So as you guys should see now, precisely what I was thinking, a large share believe that private financing is an option for borrowers with bad credit, and therefore they can't qualify for a traditional bank loan. That 100% is not the case with the private lending here at Marshall Reddick Real Estate. But again, 50% of you jumping on there with traditional banks don't offer certain niche loan programs. And that's absolutely number one reason that we see and the borrowers that we get for this type of a program. We'll dive into that. 3% there with the unsophisticated. I like that one as well. But thanks for the feedback, and let's talk a little bit about these programs. So first and foremost, we have a buy and hold program. I call this Mailbox Money. So these are going to be mid to long-term investments for you as the lender. And specifically speaking about them, we're looking at yields of 6 to 9%. All right. Again, these are going to be for investors who are looking to buy and hold rental property. Those would be the borrowers. A big plus here is that you get monthly payments. Those would be amortized, so that means principal and interest. And very important is the last item here, which talks about the maximum loan to value, 60% of appraised value. I don't want to get too much into that, but that really, really is the biggest factor in mitigating the risk involved with private lending. So in this program, any borrower wanting to work with us is going to need to have 40% down payment or 40% equity in order to qualify for this loan. So if a borrower's got 40% of their own skin in the game, I feel really, really good, right? That takes the whole worry of default out of the picture. Because if they default, I'll take the property. I've got a really, really good equity position, but I'm almost sure that the borrower will do everything in their power to avoid that default. Now, most of my folks that are looking for these loans fall into one of these three categories. Number one, non-recourse loans. And Dimitri is going to be talking a lot about that. Those would be required for self-directed retirement borrowers. So an IRA or a solo 401k borrower needs a non-recourse loan in order to buy rental property, and banks don't make non-recourse loans. The other one, 10 or plus mortgage properties. A lot of folks have 10 rental properties with loans against them. And a traditional bank can't make a loan to a borrower that has this many mortgage properties. It doesn't matter if you have $5 million in the bank and 800 FICO score. You just can't qualify. And then the third reason that I really get a lot of deals is lower loan amounts. And for those of you familiar with rental property in states outside of California, you know that $100,000 property is actually a pretty nice property. And I get a lot of 50, 60% loan to value deals where the loan amounts would be under 50,000. And the traditional banking that's out there, they just don't offer loans under 50,000. There's no money in it for them. So again, we service these kind of niche markets, and that's where my borrowers would be coming. The other program that I offer, I call QFCR, and that's an acronym I coined that stands for Quick Fund, Collect, Repeat. So these are 12-month loans, extremely fast. And just because I say 12 months doesn't mean the borrower holds the loan for 12 months. That just means that's the maximum term. So these are generally reserved for folks who are buying distressed, fixing the property, and either selling it after rehab or refinancing it with the traditional loan to hold it after rehab when it'll appraise for a lot more money. So you're going to get a lot higher yield on these, right? 9 to 12%. But take that with a grain of salt. And I say that because while I don't believe my program here is risky, there's certainly more risk involved, substantially more, than in my buy and hold Mailbox Money program, right? And that all stems from the maximum loan to value, which again is our last item here on the screen. So instead of with the Mailbox Money, which was 60% of appraised value, here we're looking at 70% of after renovation or after rehab value. So in essence, my borrowers here, which are sophisticated businesses in the business of flipping property, could potentially be getting 100% loan to value based on cost, or even more than 100%. Again, as it's based on 70% of what that property will be worth after it's renovated, right? Usually we do not have monthly payments on these loans. It's a balloon payment. So all interest is deferred until the end of the term. So Moving along, those are the two programs that we have. Again, Mailbox Money and QFCR. These three programs and the loans that we offer are good for both, all three of these that you can see. Purchase money, which probably 85% or so of the loans that we're funding on a monthly basis are purchase money loans, meaning the buyer and the borrower does not own the property yet. They are buying it with the help of this private loan. We do, however, offer the programs under the guidelines that I just went over for both refinance and cash out refinance. And I do get a lot of cash out refinance opportunities, and that often happens with self-directed retirement account borrowers, wherein they paid cash for their first or second property maybe, and they'd like to expand their rental portfolio inside that IRA. And they'd like to borrow against the equity in that free and clear home. So I get a lot of those opportunities. And if we had a property appraised today at, let's say, 100 grand, and it's owned free and clear by that solo 401k or that IRA, I'd certainly be willing to put a 50% loan to value or $50,000 loan on that property valued at 100,000, right? And collect mailbox money, a monthly payment at 6, 7, 8, 9%. That sounds like a fantastic investment to me. And I think that you'll see the same as well. So a couple other things to know about our program overall. One lender on one loan, right? So we're not pairing you with other folks or putting 6 or 7 people all on one deed of trust or on one mortgage. That could get very messy. So it's one lender on one loan. You get to see the loan, 100% transparent, and you decide if you'd like to fund it or not, right? So this is not crowdfunding, and this is not a syndication, right? We're not pooling funds, but for those of you who have been in a pool before or are interested in syndications, we actually have one coming, should be launching around the first of the year. But nonetheless, this program, again, one lender on one loan, and you are the lender, you collect the interest. Let's talk a little bit about the team here. The program's expanded substantially, and so we've hired some specific staff. And I wanted to introduce you to my 2 underwriters. So Ish Khan and Stephanie Johnson, extremely knowledgeable. You'll be working with them as a Marshall Reddick private lender, and they will be doing all the underwriting and working with you on an ongoing basis. Now, what does actually the underwriting process look from us? Well, obviously, we're taking a loan application from every borrower on every deal. From that point, we move right along. We grab the purchase contract, if applicable, from the borrower. We're obviously looking at the scope of work. If it's a fix and flip loan, like what kind of rehab are they doing to the property? That's important to know, because that's going to translate into what the property value is. Now, this will be the most important part of the underwriting process, is valuing the property. All right, this is especially important on the short-term loans where there is no appraisal. There is a legitimate third-party appraisal on all Mailbox Money loans. So the valuation, while key, is not necessarily as important. And then at this point, after the underwriting process, the deals will all make their way to the Marshall Reddick website and become available. As I've got a screen clip there on the bottom of what it actually looks like when it makes it to the website. And I'm going to introduce you to the website here in a few minutes. So from start to finish, the underwriting team here will guide you through the process. And that will work for a seasoned lender who's done maybe many deals outside of us on their own, or a first-time lender who's maybe familiar with real estate, but private lending seems foreign to them. It sounds good, but it's a little foreign. Now, after you've decided to fund a loan with us, the underwriting team will continue along, as I said, from start to finish. We're going to help you through escrow. We're going to make sure that title insurance is issued on each loan. We're going to make sure that the borrower insures the home with a policy of homeowner's insurance, right? It's really important that they keep it insured. Obviously, if the property burns to the ground and there is no insurance, The borrower still owes the lender the loan, or the principal, the capital, but it's a lot harder to repay that loan with no property. So it's absolutely imperative that we keep the property insured, and we will make sure of that. Next step is going to be obviously transferring the money to escrow. Marshall Reddick doesn't touch your money. Nobody does except for escrow, and that will always be done through a wire transfer at the close of escrow. After that, we're going to hook you up with the loan servicer. We'll have a third party that services your Mailbox Money loans, or Marshall Reddick here will internally service your QFCR loans. Ultimately, we're going to get to payoff. There's a little sample of what a payoff looks like. And then ultimately your loan will move to paid in full on the website after you collect your principal and interest back. Now, I bring the website up again because we're, again, very interested in transparency. All of our loans from start to finish will always be on the website. So I encourage you to take a look at it to see what other investors are doing, see what loans are in progress, see what loans have been funded, etc. Just spend some time. Okay, so again, the underwriting team, we're here to help you earn a great yield, and I'm sure that you'll see that, but we're also here to protect your capital, right? So my team has the knowledge to guide you through and make sure we take care of your investments. All right, so let's talk about the website, and then I'm going to bring up Dimitri to tell us a little bit how you can utilize your IRA to free up some capital. Maybe you'd like to use your IRA, like I do, to do some of these private loans. I currently, as one of my real estate strategies, I've got, I think, 6 private loans now inside my self-directed IRA. These are Mailbox Money loans that are just paying off a monthly dividend. And I'd be picking up more. All my capital's invested, right? So we'll bring Dimitri up here in a second. So you can find the mortgage page at marshallreddick.com/mortgages, or in the same capacity that I'll show you here. So this is our home page, and many of you guys are familiar with this, but if you hover over the Invest tab, the properties and the mortgages pop out. You'll want to click on mortgages. I also wanted to bring to your attention that if you don't already have an account with us, you're going to need to create one. In order to fund a loan with us, you have to have a website account. This is what it'll look like, just for a quick reference. We don't ask for a lot of information, but we do need to get some information for you. Now, let's bring up the website. We're going to just briefly talk about it. After you click on mortgages, this will get you to the list view. So with that in mind, understand that you've got several search criteria here across the top. And filters is going to be very important. You can filter out all the loans that you'd like to look at very easily. Buy and hold, that equals Mailbox Money. Fix and flip, that equals QFCR. Also important to understand the loan status here. Available means it's available for funding. Funding in process means I already have a loan commitment and we're in escrow. Funded means the loan's been funded. And paid in full means the lender's been paid back in full. So again, I encourage you to spend some time, and you can obviously click done here to get back to your list view. Now, as you're scrolling through and you find one, oh, this one might be a look of interest to me. The investment's $55,000, it pays 9%, it's a first position loan, which by the way, almost 100% of our loans are first position. We do very few second position loans. You can go ahead, you find something you like, click on full details, and that's going to dive you into what we call the detail view, right? And you're going to have all the information that we have in terms of our underwriting protocol available for you. So there's a loan details section, there's a loan third parties, right? So we tell you who the escrow company is, who the insurance company is. We're also going to give you information on the property, photos, purchase price, rehab budget, you name it. Price comparables to support that value. rent comparables. So again, I encourage you to spend some time on the website. Again, the detailed view, and understand that all loan commitments are taken on the website. You're always welcome to call us, chat with an underwriter if you have specific questions. You've got some buttons down here that are going to be very helpful for you. So if you want more information, go ahead and click request information. Myself or one of my underwriters will contact you generally within the hour, but certainly within 24 hours. And then ultimately, when you're ready to go, all loan commitments are taken on the website by clicking this Fund This Loan button. So I'd love to get into more details. I'm sure I've already run over my allotted amount of time, but I'd like to turn it over now to Dmitry Fomachenko. He's going to bring up and talk a little bit about the self-directed IRAs and the solo 401ks, how to set them up, what they do, and getting that capital available. So Dmitry, I appreciate you.
Thank you, Patrick. It's great to be here. Just a very quick disclaimer that Sense Financial is not a fiduciary. We do not provide legal, tax, investment, or accounting advice. Although all of these aspects, we talk about them, we cover them, and I can provide just a basic general guidance, but I'm not a CPA or an attorney. All right, let's move on to the next slide.
You bet.
So let's take a look and compare conventional retirement account versus self-directed IRA or 401k. With a conventional retirement account, you have an account that is held by and controlled by a custodian who allows the investments. And as you probably know, the investments are limited to basically only stocks, bonds, and mutual funds. Next slide. I want to show you an example of when I was working and I had a 401k at my work. We will get a similar sheet once a year at annual meeting that our 401k person came in and showed us the investment choices. So just about a dozen of investment choices, maybe even less. That's what you have available with the conventional retirement account. Next slide. But with the self-directed retirement account, you have virtually unlimited investment choices that are available for you. And you do see a list here on the right-hand side. This is not a full list. This is simply just the most common, most typical investments that people make within their retirement accounts. But list like this doesn't actually exist. Instead, IRS gives you a list of things that are not allowed. They call them prohibited transactions, and we will cover that a little bit later. Next slide, please. So the two options that I want to discuss and cover and explain to you tonight is Checkbook IRA and a solo 401k. So let's talk about the Checkbook IRA first. What it is. Basically, it is IRA LLC or IRA owned LLC. Those are synonymous, and basically Checkbook IRA known as an IRA LLC or self-directed IRA LLC. The way it's set up, we create a special purpose single member limited liability company. It is owned by the IRA and managed by you. So you, the client, the account, the IRA owner, become the manager of the LLC, and you control it. IRA makes investment into this LLC, and all the funds are transferred into the LLC checking account, which in turn gives you the checkbook control. It does require IRS compliance, set up an operating agreement, that's what we provide. And it allows you, the main benefit that it allows you to bypass the custodian. You can get rid of a custodian completely with an IRA. It is required. IRS requires you to have the custodian. The IRA must be held by a custodian. But what you can achieve by using this structure is bypass the custodian, transfer everything into the LLC, and then make investments on the LLC level. Next slide, please.
Yeah, and for those of you guys on the call, as we're jumping into this, I just wanted to mention that if you're interested in the retirement accounts like this, I can't recommend Dimitri enough. Such a wealth of information, and it's important to know that I think it's been about 7 years ago now, Dimitri set me up with my self-directed IRA LLC. And most recently, in the last few months here, helped me set up a solo 401k for my wife. So I just thought I'd add that in there. If you're interested, you need to speak with them. You need to take action. No one cares for your money like you do. Thank
you, Patrick, for a great testimonial. It's a pleasure to serve you and your wife. So let's continue. Checkbook IRA, how it works. So basically, we create you have to open a new IRA custodial account. Next, you're going to do the transfer. It's a qualified transfer where you move funds from your existing, it might be an IRA or might be a previous employer 401k. What you must note is that the employer sponsored account such as 401k or a 403b must be from the previous employer. Next, we create a special purpose single member LLC. And as you can see, this little man, that's you, and you are the manager, so you control that. Next, we do instruct the custodian that your IRA buys units of the LLC. And once it's done, then you have the ability to make all of the investments from the LLC. And next, you have the ability to collect all of the income directly goes into the LLC checking account, and all of the expenses are paid from the LLC checking account. So by doing so, you're able to bypass the custodian. The custodian is actually on the side. Their role is a passive custodian. They don't have access to your funds. They don't see what's happening inside of the LLC. There is no transaction fees. There is no delays. So it gives you the control, total control over your funds, and gives you speed to act on the transactions. And just making a comment also on Patrick's program, Patrick helped me. Basically, I used my retirement funds as well as my personal funds to fund some of his loans. And some of these loans, if it's a good deal, if it's a good return, they actually go quickly. I think he did mention that because there is a line of investors that he accumulated who want to invest their money, want to put their money to work. So if you see a deal and if you're not able to jump on that right away, with a custodial account, you probably will not be able to take advantage of that because somebody else will jump on that. Because with the custodian account, you need to submit the paperwork to the custodian, get the authorization, and then a few days later, the funds can be transferred or directed by the custodian. And again, you last a few days and you possibly lost the deal. Next slide, please. Now jumping on to the second option, the second option that gives you the checkbook control is a solo 401k. And solo 401k is I love this vehicle. It's known as an ultimate retirement plan. It's not a new type of plan. It's defined under section under Internal Revenue Code section 401, subsection K. So it's defined as retirement savings trust. And this particular plan designed for those people who are either self-employed or small business owners. Basically, it's a plan that covers the business owner and his and her spouse, if spouse is also involved in the business. So basically, again, it's designed for those people who are self-employed or own a small business without full-time employees. And by the way, the definition of a full-time here is someone who's working 1,000 hours or more per year for you. So that's about 20 hours a week. So you are allowed to have part-time staff, just cannot have full-time employees, because if you do have someone working more than 1,000 hours a year for you, then by law you must offer them benefits, retirement benefits as well. Regardless whether they're going to join or not, you have to offer that to them. And Solo 401k is simply not designed to include any employees. The increased interest in these plans was as a result of changes in the tax law in 2002, which actually made many benefits that this plan offers available. And I'm going to talk about the benefits in a couple of slides, but that's really the key, what makes this plan so superior compared to everything else. Next, please. So let's talk about the eligibility. Who's eligible for a solo 401k? Basically, there is a twofold eligibility criteria that you need to meet. Number one, you need to have a presence of self-employment activity. This can be in any shape, type, or form. It can be a doctor who's independent, can be an attorney with small practice, or maybe even an attorney who's working in a corporate environment and just have a side practice. So I have many clients who actually employ full-time and they running a small business on the side. Pretty much anything, as long as you have self-employment activity that generates earned income, and that's key also, you have to have earned income. Passive income, such as income from rental properties or income from lending, does not qualify unless you actually run a company that does that. Some people sometimes ask me, well, I do own 3 rentals and that's my business. Well, rental income is considered passive and it's not eligible unless you actually set up a property management business to run that, which is a possibility. And we can discuss that one-on-one. And then second criteria is absence of full-time employees. Again, you're not allowed to have anyone working for you more than 1,000 hours a year. And as you can see, those criteria is easy to meet. And if you don't have business activity, you can easily start one. It's always good to have something, to have additional source of income. And I had actually many clients, once they learned the benefits that Solo 401k offers, they decided to just jump in and create a Solo 401k, create the business and then create a Solo 401k. But just starting a business on the side is good because you're creating a second income stream. You know, one thing that I learned a number of years ago at one of the seminars that I attended is creating multiple streams of income. So if you have a job, that's great. This is your, if this is the only source of income for you, then it's very important that you think about alternatives, because this job is today, but can be taken away from you tomorrow. And you can, in addition to that, you can start lending. Work with Patrick and create additional source of income as interest on money that you lend. And also you can start a side business. So basically the only thing that will prevent you from setting up a solo 401k is if you own a business with full-time employees, then that you're disqualified. It will not work for you. Next slide, please. So let's look at how it works. The first step is you need to have a sponsor of the plan. And that can be any type of business. Like I said, it can be a sole proprietor, can be a corporation, can be a partnership, an LLC. So any type of business structure will qualify. Then this sponsor adopts a solo 401k plan. That's when we come in and we create the plan, documents, and a trust. And trust is used as a vehicle to hold plan assets. And you, similarly, in the IRA LLC structure, you become the trustee of the trust. And as a trustee, that's what gives you the control. Next, you're able to go to any bank of your choice or any other financial institution and open up a bank account for a trust. Trust is an entity with its own unique name and with a tax ID number, registered as a tax-exempt entity. Next, you're going to be able to buy assets in the name of the trust As a trustee, you direct that, you make the investment decisions. Next, you will be able to, all the income that comes from the properties will go to the bank account or brokerage account, whatever you have, and all of the expenses will be paid from that account. So again, you control that with the checkbook. And you're able to completely eliminate the custodian out of the picture and have total control. Next slide, please. So the benefits of the solo 401k are what makes it superior to any other retirement account. And one of the main benefits is that it gives you a high contribution limit. In this year, the maximum contribution limit is set at $60,000. And that's nearly 10 times higher compared to an IRA, where the max you can contribute is $6,500. Now think about this. If you and your spouse are running business together, then you potentially can double that contribution limit up to $120,000. I mean, that's pretty amazing. It's a great tax sheltering vehicle. Second benefit is that it has a loan feature allowing you to access your retirement funds anytime, up to $50,000 or 50% of the balance, whichever is less. So basically, by having this feature, you're creating your own bank that no one is going to turn you away. You always have access to those funds. Next benefit is ability to make post-tax or Roth contributions. And the maximum limit on that is $24,000 compared to a Roth IRA, $65,000, and it's not dependent on your income. With Roth IRA, if you're making over certain income threshold, you're not eligible to make those contributions. With the solo 401k, you can make Roth contributions regardless of your income. Next feature or benefit is checkbook control, and it's very cost effective. Because there is no custodian, you eliminate all of the custodian fees, all the transaction fees, and all of the asset-based fees. You become a trustee of the plan. There is no TPA or third-party administrator, and it allows your spouse to also participate if your spouse is eligible, meaning your spouse is also employed in the business. So you can double the benefits at no additional cost, no additional effort on your end. Next it is exempt from unrelated debt finance income tax on leveraged real estate. And very quickly, don't have time to develop that, but if you buy rental real estate inside of an IRA and use leverage, then you will be able to, the income that you receive from the leveraged portion of the property in an IRA will be subject to UBIT tax, unrelated business income tax, but the solo 401k is exempt from this particular taxation. So you can buy real estate, use leverage, and pay zero taxes. Next slide, please. And another benefit that it really allows you to have a true diversification, because, and this is credit to my daughter who helped me create this presentation. She drew this cartoon, man holding a basket, and the bottom fell off and all the eggs are broken. And wife says, well, I thought our investments were diversified. Well, if they're all in one basket, they're not. So if you're investing in stock market or even mutual funds, which might be diversified across different stocks, you're still invested in one asset class. In order to achieve true diversification, you need to have self-directed IRA or 401k, because you can truly diversify between different asset classes with this vehicle.
Yeah, absolutely. And just a comment there, I mean, I'm watching the stock market, and it just continues to go up and up and up. And, you know, as an investor, I'm starting to look for a safe haven. I mean, I'm a real estate guy, that's for sure. But, you know, a 50 or 60% loan to value first trust deed or mortgage paying me 7 or 8% with monthly payments certainly seems like a pretty good safe haven to me. If you're like me and thinking that we're in for a market correction here pretty soon.
Yeah, totally accurate. So, as far as the investment choices, again, you can invest in virtually anything. I, just like Patrick, we both started with real estate investing. We are, known Patrick for well over 10 years now. And I started as a real estate investor, dealt with rental properties, dealt with few fixer-uppers. But several years ago, I transitioned or started doing private lending, and I loved it because I'm getting good return. My principal is protected, so the risk is low, and it's really hands-off. I do have a business to run full time, and I don't really have the time to manage my rentals. So most of my portfolio transitioned into private lending and really enjoying that. But you can do also real estate, you can do commercial, multifamily, you can invest in private businesses, you can do tax liens, you name it. Next slide, please. Now, let's talk about what it is that you cannot do. And basically, IRS in the Internal Revenue Code section 4975 describes prohibited transactions. And it says that there is only certain investments that are not allowed within a retirement account. Number one, it's collectibles, such as stamps or coins. Number two, S corporation, because you have to be a physical person to be part of the S corp. You can invest in the C corp though, by stocks. And then life insurance contracts. So those are the only investments that cannot be made within the retirement account. Next, I will show you who the disqualified person is. And basically, IRS rules say that your IRA or 401k is not allowed to engage in any transaction with disqualified person. And disqualified person basically is yourself and your immediate family members, which is your spouse, your ancestors and lineal descendants, spouses of them, your investment advisor, fiduciary, and any business entity in which any of the above owns 50% or greater interest. So basically, several people cannot engage in your IRA in any capacity. And I think I do have a couple examples on the next slide. But basically, what is not allowed is sale, exchange, or leasing of any property between a plan and disqualified person. And an example of that will be question I get asked once in a while: if you own a property, can you transfer that into your IRA? And the answer is no, because you own it. Transferring that meaning selling to the IRA, you're a disqualified person. You cannot do that. Next, lending money or extension of credit. Cannot do that either. That's why the loan has to be non-recourse, because you cannot use your credit. You cannot guarantee the loan. Has to be non-recourse, meaning there is no recourse against the property is the only recourse on the loan. Next is providing goods or services or facilities between a plan and disqualified person. Another example of this will be if you're a real estate agent and you want to buy a property in your 401k, you can't represent your 401k. You can be an agent in the transaction, because that will be considered providing services, and it's not allowed. Next, transfer to or use for the benefit of a disqualified person of income or assets of the plan. Again, the plan must benefit. It's not for your current benefit. If you buy a vacation rental, for example, you personally cannot use that. Your children cannot use that. Your spouse cannot use that. It's for the benefit of the plan and for your future benefit. You can distribute that property out of an IRA when you retire and use that for your own benefit. And then any act of disqualified person who's a fiduciary where he deals with the income or assets of a plan in his own interest. And finally, receiving any consideration for your own personal account by any disqualified person. And again, if you are a property manager and you own a property management company, you cannot use the property management company to manage property that is owned by your IRA or 401k. That will not be allowed. It will be a violation. Next, please. And that's what Patrick was talking about. We are actually on the upswing of the stock market right now, but whether it's upswing or downswing, we can actually reverse this and it still would look like a stock market. You know, when you're going up, you know that after the next turn, around the corner, you're going to go down. So that's definitely that's how the stock market works. And if you're smart, you can diversify out of that. We had a limited time, so I know I was just barely able to cover everything, but I will be happy to speak with each and every one of you one-on-one. I do offer a complimentary 15 minutes consultation, and you can request that by going to our website, sensefinancial.com/free-consultation. You can actually see that link on the home page. If you just go to our main page, you will see that how you can request a consultation. And here's my contact information. You can reach out to me via email, or you can call our main office, and one of my girls will schedule consultation with you. So that concludes my part, and I think we might have some time for questions. Patrick?
Yeah, appreciate the information. And for the investors on the call, we do want to be cognizant of everyone's time. As Dimitri mentioned, he'd be happy to have a one-on-one consultation with you. I would be happy to do the same with regard to the Marshall Reddick Private Lending Program, as I'm sure there is a myriad of questions that come to mind. I mean, we covered a lot of information. It's always difficult to do it within a specified amount of time. And as far as the slides go on the PowerPoint tonight, more than happy if you'll send me an email. I will email you back a PDF copy of those slides so that you can study it a little bit further and perhaps come up with some other questions. So I actually think we're going to end it now, cognizant again of everyone's time, not take any additional questions, but do save them. Both Dimitri and I would be happy to speak with you. But that will conclude our presentation tonight. We certainly appreciate everyone taking the time to join us. Dimitri, my friend, thank you so much for joining. I know you're a busy man. And we'll send off with that.
All right, thank you. And Patrick, I believe you're recording this, right? So they can have access to the recording as well, right?
Yes, absolutely. So for those registered and even for those that weren't able to attend, we have recorded the presentation as we always do. You'll get an email, I think by noon tomorrow, that'll have a link to the website where you'll be able to watch it at your convenience.
Thank you, everyone, for joining. Have a good night, and hopefully we'll talk soon.
Yep, absolutely. Look forward to speaking with you guys. Have a great evening.